Welcome back, dear students and scholars. In this first lesson on ASC 270, we are starting with a simple but important idea. Quarterly reporting is not just annual reporting cut into four neat slices. Interim reports cover shorter periods, so the numbers often depend more on estimates, allocations, and timing judgments. That is exactly why ASC 270 matters. It helps us understand how financial reporting should work when users need information before the full annual report is ready. ASC 270 sits inside the presentation and reporting area of US GAAP. Think of the codification as the organized library of accounting guidance and ASC 270 as the shelf that deals with reporting for periods shorter than a fiscal year. It does not create a separate measurement rule for every asset, liability, revenue, or expense. Instead, it tells us how interim reporting should connect back to annual accounting principles already found across the codification. Interim reporting means financial reporting for a period shorter than one full fiscal year. The most familiar example is a quarter, but a half year report or another short reporting period can also be interim reporting. The key point is that the financial statements or summarized data are being prepared before the full annual cycle is complete. For public companies, this becomes especially important because investors and regulators are watching quarterly performance closely. ASC 270-10 overall covers two broad areas: accounting issues and disclosure requirements for interim periods. On the accounting side, we are asking how annual accounting principles should be applied in a shorter window. On the disclosure side, especially for public reporting entities, we are asking what minimum information users need to understand current results. So, this topic is not only about numbers, it is also about explaining those numbers responsibly. Before we go deeper, it is important to know what ASC 270 does not do. It does not require every entity to issue interim financial statements. It does not replace annual US GAAP principles. It also does not turn every quarter into a full annual report. Interim reporting is condensed by design. So, if annual reporting is the full movie, interim reporting is more like a carefully edited episode. Useful, timely, and serious, but not the entire story. Interim reports matter because users cannot always wait 12 months for financial information. Investors watch trends in earnings, margins, and cash flows. Lenders monitor liquidity and covenant compliance. Analysts update forecasts as new quarterly information arrives. The objective is timely, decision useful information. The challenge is that speed comes with pressure. The faster the reporting window, the more disciplined the estimate process must be. The central problem in interim reporting is the tension between timeliness and reliability. A cost allocation error that may look small over a full year can look very large inside one quarter. Items like property taxes, bonuses, advertising campaigns, and tax estimates often relate to more than one interim period. ASC 270 gives a framework for handling this pressure without pretending that every quarterly number is as complete as a final year end measurement. The first major concept is the integral view. Under this view, an interim period is part of the annual period. That means the entity may estimate annual effects, allocate costs when appropriate, and adjust later quarters when better information becomes available. The annual period is the main story, and each quarter is a chapter inside that story. A chapter matters, but it should not be read as if it were the whole book. The contrasting idea is the discrete view. Under that view, each interim period stands alone like a mini accounting period. Revenues and costs are recognized only in the period in which they occur, and there is less smoothing or allocation across quarters. This may reduce estimation, but it can create more volatility. We study the discrete view because it helps us understand the debate. But for ASC 270, it is mainly the contrast, not the main anchor. ASC 270 generally prefers the integral approach. The practical memory point is simple. Begin with annual accounting principles, apply only the interim modifications that the guidance supports, and keep reporting consistent across quarters. Do not invent smoothing just because a quarter looks ugly. Accounting standards are not a cosmetic filter for earnings. The purpose is to represent performance fairly while recognizing that interim reports are part of a full year reporting cycle. Now let us separate the public and non-public lens. General ASC 270 guidance can apply to any entity that prepares interim financial statements under US GAAP, including private companies reporting to lenders, boards, or contractual stakeholders. Public reporting entities have additional expectations because they report to investors and regulators. So the same foundation applies broadly, but public companies face a more formal and disclosure heavy reporting environment. For public companies, the Securities and Exchange Commission requires quarterly reporting through Form 10Q. This report includes condensed financial statements, management discussion and analysis, and important interim disclosures. It is not the same as a full annual Form 10K. The 10Q is summarized and updated from year end, not rebuilt as a full annual report every quarter. That distinction is important for both preparers and students. Seasonality is one reason users must be careful with interim reports. A retailer may earn a large part of annual revenue in the holiday quarter. An agriculture business may have activity concentrated in one season. Temporary events such as strikes, weather disruptions, or supply chain issues may also distort one quarter. Add estimate revisions for tax rates, bonuses, and reserves, and you can see why one quarter should be read with context, not with overconfidence. A useful starting checklist for ASC 270 has 5 steps. First, use annual US GAAP principles as the base. Second, apply proper cutoff. Third, estimate carefully and document the basis. Fourth, allocate only when the guidance and facts justify allocation. Fifth, update later periods when estimates change, unless another standard requires restatement. This checklist is practical for exams, audits, and financial reporting work. This course is structured in 5 focused videos. This first video gives the meaning, scope, objective, and reporting philosophy. The next video goes into detailed rules for revenue, expenses, inventory, income taxes, and specific ASC 270 modifications. After that, we will work through examples, then practice questions, and finally a quick revision with comparison. The goal is not to memorize a topic mechanically, but to understand how interim reporting decisions are made. Let us close with the 5 memory anchors: period, purpose, approach, entity lens, and estimate risk. The period is less than one fiscal year. The purpose is timely decision making. The approach is mainly integral, using annual principles as the base. The entity lens separates general reporting from public company requirements. And the estimate risk reminds us that short windows magnify judgment. If this helped you, please like the video, share it with your colleagues, subscribe to Commerce Regiment, and support the channel. In the next episode, we move from the foundation into the detailed ASC 270 rules.